Good evening, everybody. Welcome. I hope you guys are all having a good Saturday night, and you guys are having a lovely, lovely weekend. Thank you all for joining us. This is our seventh segment that is actually brought to you by Bursa Malaysia. So I'd like to thank Bursa Malaysia for bringing this webinar to you. Now, today's topic is about discovering investment grade stocks and how you guys can do it as well. And of course, over the long run, make some good returns. Notwithstanding, if you look at existing markets, volume has increased tremendously from 1 year ago. So we're here talking about investment grade stocks, right? So this is going to be quite different from the existing market. I also hope that this segment will help kind of ground you guys back to fundamentals, because eventually, when stock prices rise and eventually if the fundamentals don't follow, it's unlikely prices will remain at the same level, right, as it is today, right? If fundamentals cannot be caught up, right? So good evening, everybody. Florence, Jason, Sing Tae, Daniel, Muhammad Saiful, Tony Leong, Chia Chuan Chun, right? Jitinder, right? Welcome. Good evening. So if you guys like what we're doing, do share and follow our page, or even share this segment with your friends. Yeah. So warm welcome. So I'm going to get started now. Of course, if you guys have any questions at any point in time, just post it there, and then we're going to do the Q&A session, right? So this is going to be a educational session brought to you by Bursa Malaysia. So before I get started, I just want to do a very quick disclaimer. We will be talking about stocks. I'll be using some case studies as examples. The whole idea here is to get you guys to become more informed investors. Of course, none of this is going to be constituted as financial advice. Okay, I just want to highlight, and whatever we say, buy, sell, or hold, or do anything else. So none of this is purely for informational purposes and educational purposes. So if you guys decide to buy, sell, hold, buy any stocks that we've talked about here, please seek your professional advisor for advice on investments. All right, so this is purely educational and informational purposes. Now, I think most of you guys know me. My name is Alvin, so I'm going to be running this whole series with you guys. This is a 7th segment. I know the last segment Betty was on. I think I was on for three of the 7 segments. Of course, yesterday we just had one, which is also in Mandarin, by also brought to you by Bursa Malaysia. Now, let's get started. Now, before we get started, I also want to make this interactive. So I want you guys to comment, because I'm gonna have one exercise where I'm gonna get you guys to sort of think about it, and then give me an answer, right? So if you guys can post in the comment section what you think your answer is, and that is the whole idea. Now, to set the landscape first, let's sort of get it clear, right? That when we talk about investment grade stocks, essentially we're talking about investing. So if you guys want to make money, understand there are 2 ways you can make money. There's no wrong or right. Essentially, you can either speculate, or you can invest, right? So those are 2 options, right? So if you're using the investment mindset, it's very different from speculative. So speculative is very much you go in and then you come out, right? Investing is basically you are buying a business, you're investing over the long term, and you're hoping that the price will be reflected as the business becomes better, right? I do have to add that, although fundamentals are a very key point when we come to value investing, sometimes you also need to be very patient, right? Sometimes you need to wait till your stars align until you can actually get or capture some of those price gains that you hope to get. essentially in buying an undervalued stock, right? So I just want to set the ground that we are talking about investing, and it's not a speculation technique. So at the end, or part of this segment is actually I'm going to show you guys how there are 4 factors you can actually check if a company has growth. Okay. So if you're buying companies today and you want to know, obviously you want to grow with them, there are certain clues that you can actually use to actually get the 4 factors, all right, to get growth. So largely, a lot of our investment methodology and style is based upon, he's known as Benjamin Graham, the godfather or grandfather of value investing. Not to read directly from his book, right? But really, I took this excerpt out. I thought it was quite good. He put it in very concise terms. He says, look, investment is where you have to do thorough analysis, which means you have to do homework. After you've done that, you will know whether it's safety of principle. So when we talk about investment grade stocks, it's largely going to talk about safety of principle. And of course, the last one, if you can find a good company with a relatively low risk, you definitely want to get more than what you're going to put into conventional fixed deposits, right? So in the case for investors like us, if you're going to put money into a fixed deposit, you get 2-3%. The whole idea about investing is that can you take a little bit of risk and actually compound that amount a lot faster. All right, so that's sort of the idea behind it, right? Okay. Again, if any of you guys want to be a value investor, do pick up this book. I can tell you from my experience, it will take you a long time to actually finish reading it because it is a very, very dry book, all right? And it was published in the 1920s, right? End 1920s, 1929 or 34, right? So after the Great Depression. So that's the kind of language you need to get used to. Now, at the end of the day, investing is about if I can just put this here, it's actually about certainty. Why are we here discussing investment grade stocks? Because investment grade stocks give you a level of certainty. So it depends what kind of investor you are, right? I know a lot of people can take risks. I also know a lot of people who cannot take risks, right? So if they see a 5% drop in price, they get pretty nervous. Now, the whole idea behind investing is to get a lower risk to reward. Okay, that means for the lower risk that you're taking, you want to get a better return ratio. Okay, rather than taking very high risk and get high return. So you want to lower your risk and get decent return, right? And actually at the end of this, I'm going to show you guys how investment grade stocks can give you very decent return without having to take excessive risks. Okay, so this is not speculation. We're not talking about turnaround companies. We're actually talking about investment grade stocks, right? So those of you just joined us, welcome. This is an investing webinar brought to you by Bursa Malaysia. Now, okay, so to give you guys an idea, get in the mind frame about investing, I just want to give you guys an idea. So if you can see from my graph here, you can see that purple is actually 10%, the green is 6%, and the red is actually 3%. So if you can imagine your red being a return, right, in your fixed deposit, that's really what it will look like. Okay, so if you look at this, if you look at this, so I assume that you're $1,000. So if you have a few more zeros in your bank account, you can add a few more zeros. But essentially, it's the same. The whole idea about compounding interest is if today you put 1,000 in and you make 2,000, you want to compound that 2,000 become 4,000, 4 becomes 8, 8 becomes 16, and so on and so forth, right? Just to give you an idea, if you look at this, so this is after 10 years, 15 years, and this is 20 years, right? So if you're able to compound at 10%, this is of course a very long period, over 20 years, you're actually going to get almost seven times your initial investment, right? And the whole idea why I'm sort of giving you guys an idea is that because investing actually takes time, right? So in the beginning, right now, I'm seeing a lot of retail participation. Things are going up a few percent every day, or limit up, 20-30%. Looking at globally, even historically, typically, yes, markets do behave like this, but not in the long term, right? In the longer term, they don't normally behave like this. So the whole idea here, if you're speculating or you're in a very hot market, you're gonna think that, oh, it's so easy to make money, right? Randomly pick some stocks. But in the longer term, this is really where you want to look at building your portfolio. Is that can I turn $1 into $20, right, over a period of time, right, without taking excessive risk? And the way to do that eventually is actually to be building a portfolio, right? So Casey, faster get to the point. All right, I do have quite a few slides, but that's my point. Okay, so here's my point to you, right? Assuming you start with $100 at the beginning of the month, and you double your money every day. So I want you guys to sort of guess, right? How much do you think you're gonna have T plus 30 days? All right, so I'm gonna give you guys a couple of minutes and just point it out there. Put in a comment below that if you started with $100 and at the end of 30 days, how much would that $100 become? So put down any number. I'd like to see some responses. Put down any number. And then, of course, I'll show you guys the answer, right? So there's something interactive that I hope you guys can actually experience, right? While this being a live stream, right? Can I get some answers or comments from below? If you started with 100 and you double every day. So I'll give you an example, right? So today's 100, tomorrow's 200, becomes 400, 400 becomes 800, 800 becomes 1006. That's after 5 days, right? Then 6 days is 3002. So if I get some answers below, if you guys can comment, what if you had $100, what at the beginning of the month and you double your money every day, how much would you have T plus 30, right? If I can get some of you guys to give me some responses, that would be great. Now, please don't sort of use your calculator and kind of multiply 30 times because it's going to take you a long time. I just want you guys to guess a number, and that's the whole point, right? To give you an idea why compounding is very powerful, right? Especially for portfolios. So Casey Chow, now my turn to get you to faster respond, right? What kind of answers do you guys think we will actually get, right? Assuming you started at $100, what is your end amount after 30 days with 100? Going once, going twice. Do I get some comments, right? What is it that that you think we'll end up with, right? T minus 30 days. Right. Okay. I'll show you guys the answer. Since no one wants to guess, right? So there we go. 30K. Right. Okay. So I'm gonna show you guys 1 million. All right. Keep going. Right. Keep the answer going. It's 100K. Guess. Keep going. Look, that's the whole point. This is a guessing game, right? So I'm gonna get you guys to be a bit interactive. 1 billion. Okay. We got 1 billion. 3 million. Oh, that's a long number. 𝗏𝘃𝗀𝗁, right? That looks like your phone number. Lawrence, 50K, 100 million, 50 billion, right? I should throw a prize, right? If you guys. So the whole idea of doing this exercise is actually not to actually go and pull out your spreadsheet and actually do it, but really sort of just to guess what you're gonna get, right? So you got 53 trillion. Wow. Okay. You got 600,000, 50 billion. Okay. 107 million. Hello, you guys have got good guesses. 500K. Okay, 100K. Yeah, good guesses. 100K, good. Okay, so I'll show you guys the answer. 53. Okay, I if you guys got that 53, which means that you use the calculator, you did it wrongly because you did T plus 29. So compounding starts at year 0, not 1 to 30. So you got 0 to 1. So it's 30 periods, right? For those of you who actually did it, right? Just to give you an idea about compounding, right? So until you actually practice it, then you kind of guess, wow, where you're going right or wrong. This is the answer. It's actually 100 billion, right? I think who came closest to it? Let me see who came closest to it. I think someone did say 100 billion, right? Did we get something? 100 mil, 1 mil, 100K. Well, kind of close. We got 50 billion. That's 52 billion, right? Yeah, it is 10 billion. So this is congratulations, 𝗁𝘁𝗃𝗲𝗁. Congratulations from YouTube. You were the closest. Oh, 10 billion. Sorry, I thought I saw 100 billion. Okay. No, you're not the closest. Someone with 50 billion was kind of the closest, right? But you guys kind of get an idea what I mean, that if you're able to compound that amount, of course, you don't. The whole message is very simple, right? A lot of us think we need a big number to start with, to end with a very big number. All right. I think that's kind of the general mindset, that when I speak to people, I get that feeling, right? That I need to have a lot of money before I start investing. I don't think that's true, right? It's really how quickly you can compound and at what rate. That is what makes the difference. So when you talk about compounding in terms of rate, it's very much dependent on your skill set and time, right? I think all of you guys have at least 5 years, or at least to have a 5 years time horizon to invest. You just have to be fairly patient, and that's really about it, right? So now the question is, how do I get my compounded return as high as possible, right? So I want to share with you guys some ideas on what you can do without actually taking too much risk. So that is the lesson from this slide that I wanted to share with you. You don't have to start with a lot, to actually end up with a lot. That is the message here, because we only started with 100. Okay. Now, of course, I wish I could double every day for 30 days, right? Then that would be very nice, wouldn't it? But you think about it, the day before this, that means T plus 29, it was already 50 billion. Right, and T plus 28, it was 25 billion, and T plus 26, it was 12.5 billion. So you can see the real compounding. If I show you guys this, actually really comes at the end here, right? So this is where you have to be a bit patient. All right, I see a lot of investors are not as patient. Okay, so when it comes to investing, really the idea behind this is, you have to look after your risks, right? There are two types of risks that you have to cover. The first one is actually what we call capital at risk. So this capital at risk ultimately is what risks are you taking? Essentially, what's the stocks that you're buying? What is the risk, right, that you're carrying, right? The second risk that my colleague Benny has run quite a few segments is about timing, right? So how do you lower your timing risk and lower your capital risk, right? So when it comes to investing, or specifically value investing, one of the things that we most treasure is actually your capital at risk, meaning that how much risk are you taking for the money that you've actually put in, right? So we're going to very much focus on the capital risk part, and that's where your investment grade stocks actually do come in, right? Now, just understand this. These are the 4 things that you have to get right. But inadvertently, I'm not sure if you guys are aware, whenever you buy a stock, you put a stock name, you put a price, you put a buy and sell, you put a quantity. Actually, each of these segments that you have to put down in, each of them actually deals with risk. And the whole idea here is how much effort you put to cover that risk is essentially how much return that you are actually going to be getting, right? Let me give you an example, right? So if you're finding a good stock, for example, you want to lower your risk, that's your capital risk, right? That's your homework, that's your thorough analysis. Price is all about timing, right? And you can never find the best time, right? And of course, you've got the buy and sell, which is where you need to decide, which is also timing as well. But the last part is something that I do want to highlight, because I think very few people put a lot of thought into quantity. So every time they buy, okay, I want to buy this stock, I want to buy at this price, but how much do I put in? And then, we give it a 2-second thought, or we try to figure out what's our balance. Let's put that all in, right? So when you actually start thinking about quantity, you actually start thinking about investing using a portfolio, and that's really the whole idea behind it, right? Okay. So I think there's a good question here, right? So based on being an expert, right? What's the fair value of 𝗗𝗃𝗃𝗃𝗃𝗃 based on its projected doubling of production capacity in the next 3 years? Now, so this can be answered. So when I go into factors of growth, I hope I can answer this question in a bit more detail, right? From Eng Kong. So I'll get to there eventually. Just bear with me, right? Now, when we talk about, I think most of you guys may have seen this in the earlier segments, right? If you haven't seen it yet, this is, let me just very quickly explain to you when we talk about risk, right? Now, if you look at this, we're saying that generally companies move through a life cycle, right? And every business starts small, eventually get bigger, and they reach the top. And then if they don't sustain, they don't innovate, and they cannot compete at the top, they eventually will come down, right, to sunset, or the question is turnaround, right? So the whole idea behind this is what we actually want to look at the business, actually understand the business. If you cannot understand the business, you won't be able to place where they are on the graph, right? The whole idea here is that every time a company moves between some of these risk profiles, I call them, you are essentially, that's where you make the money, right? So you find a startup that's actually found that the business model works, and if you read Jim Collins' Good to Great, they call him the hedgehog, right? So if your company has actually found your hedgehog, right, essentially they're doing the right thing and they just need to scale up. Eventually, if they scale up and they move bigger, they move into this thing called an emerging grade and eventually an investment grade company, right? When you actually look at the risk profile, you go from high, medium, low, and then of course investment grade companies also come down, right? There are very big companies that have actually failed. No one expected it to fail, but that actually happens, right? And then eventually, if they fail, they move into sunset. And then ultimately, the question is, can someone come in to turn this company around? And that's where you get the turnaround strategy, right? So you need to understand each company at which point, what are you actually investing in? The whole idea here is to risk profile it right. Okay. Now, the idea here, right? Today's topic, we're going to be talking about investment grade stocks. Now, however, what I've got to give you a very big caveat when we talk about investment grade stocks, right? Unfortunately, the criteria I'm going to give you is going to be based on data. Okay, that's the first one. Number two, data by itself is not good enough. You need to have context, which means that you need to understand what business they are in. Okay. Now, when you purely only look at data, this is what can happen. An investment grade stock, right, can also, a business that's already in a sunset business can also portray the same data as an investment grade company. Okay, so I just give it. So because they're literally right next to each other, and I'll show you the criteria later, and I'll explain a little bit why it can be, right? So you can't just use the criteria that I want to share with you like blindly without understanding the business. Say, yeah, let me just buy all these companies and I'll be fine. Unfortunately, it doesn't work that way. You still have to understand what the company actually does. So understand that there could be sunset businesses portraying themselves as investment grade. Okay. And they are both very different risk profiles, as low and high. Okay, but you're not going to get an investment grade stock that looks like a startup. That's for sure, right? You're also not going to get an investment grade stock that looks like a turnaround company. So I just want to highlight that. So let's come back to investment grade stocks, right? Now, the whole idea why we're trying to look at investment. Now, investment grade stocks are very simple. They're consistent, they're reliable, and they're sustainable, right? The whole idea here is that the sustainability is where you actually need to understand the business or understand the industry to sort of get a feel of what exactly the company does, right? So what are the three criteria? It's actually very simple. We only look for companies that have been consistently profitable, that have been consistently paying dividends, and has consistent positive operating cash flow. That's the three criteria, right? If I actually run this through a data set that I have, today I probably get about 110 companies that actually fit this criteria, or 120 to 110 companies that fit this criteria today. And when we say continuous, and that's really where the keyword is, right? Which means that every single year in the last 10 years, they must be making money. right? To come back to the whole point about being consistent and reliable. So if you can find a company that's consistent and reliable, essentially what you're actually trying to do is actually lower your capital risk. Now, the whole idea behind this is that if you can find something that's continuously reliable, and for some reason, today or tomorrow or sometime in the future, it's selling at a much lower price, or the price hasn't moved for a long time, right? Those are what I call very low hanging fruits, easy to pick, easy to make a profit from. Okay, so so that is the whole idea behind it. So this is not high risk stuff. This is very low risk stuff with very decent returns, right? So I'm going to show you guys some of the returns that you're actually going to be getting. Maybe I'll skip to that. I want to give you guys an idea what we mean by these returns, right? So I do have quite a bit of slides here. Let me show you the return, right? So what I did was I took a data set from 2015, right? And at that point of 2015, I looked for stocks every year paid dividend, every year had net profit, every year had positive operating cash flow. I filtered out probably about 111 companies, right? And then what I wanted to do was from January 2015, if I bought these stocks all the way to January 2020, and the reason why I did January 2020 was really before this whole COVID thing happened, and we have a lot of volatility. So we want to take it during normal market times. What kind of returns? Now remember, 2015 to 2020, we weren't in a bull run. In fact, the pace of the market at that point was actually quite flattish, right? And if you had, so I actually pulled out 20 companies, I ranked them based on return, right? And also showed you the sector they were involved in, right? So these were all under normal circumstances, right? Of course, if I did these numbers today, they are way, way, way higher, right? For 2020. Actually, what came out right on top was actually 𝗕𝘃𝗃𝗃𝗃. Just to give an idea, so if I look back in 2015 and I did a filter, I would have found 𝗕𝘃𝗃𝗃 would have hit my criteria, because every year they pay dividends for the last 10 years. That means for 2015 to 2005, they made profit, paid dividends, and had positive operating cash flow, right? Those three criteria. If I bought it back then and just purely based on price, excluding any dividends, they would have returned actually 6 times, so 600% return, right? So $1 becomes $6, right? Your compounded return is actually 47%. Now, if you think about this, of course, I think a lot of people will compare to glove stocks and so on and so forth today. But let's talk about purely normal market conditions. These are very exceptional gains for a company which is very reliable, very consistent, right? Without taking a lot of risk, you're actually getting a 47% compounded return, which is huge, right? If you compare to your fixed deposit rate, that's only 3, right? So that's almost 15 times what you get in fixed deposit without having to take the extra risk. Now, I also did Top Glove actually ranked number 2. And this was before COVID-19. This was January 2nd, right? On the first trading day of January. If you have held it during that same period, you have gotten a 400% return 4 times in 5 years. Yeah. As you go down, Magni, KSM, 𝗵𝘃𝗃𝗀𝗃𝗃, QL, 𝗂𝗏. I think someone asked me about 𝗂𝗏. This was all before the pandemic price increase. You are looking at very, very high numbers, right? Exceptionally, on average, 20%. Purely based on price, and this is the second 20, right? And you're gonna realize what is interesting is this, right? Where we are today. If you look at this, out of 20 stocks, I got 1, 2, 3, 4 consumer stocks, 5, 6, 7, 8, 9, 10. I essentially got 10 out of 20 top 20. 10 are actually consumer-based stocks, right? Or they actually come from the same sector. So it sort of just give you an idea that if you invest in some fairly boring stocks that are in the consumer market, they actually represent 50% of the top 20 in terms of return in normal markets, right? Very exceptional, right? So you're looking at least 2 times, 3 times 200%, at least 200% return. Actually, right on number 21 is actually Nestle, right? But I did top 20 only, so but I just want to give you guys an idea. What was interesting was that when I did this research, you actually your top 20, half of them are actually consumer products and services, right? And what is interesting today when I look at them, a lot of the consumption-based companies, in fact, their prices have fallen quite a fair bit, quite significantly. So if I did the same filter today, they won't appear on the list, right? Glove stocks will be right on top, right? Along with all the other stocks or healthcare specifically, right? So just to give you guys an idea, so they perform really, really well, and now for whatever reason, they're not performing well, purely based on price, right? However, their fundamentals, the whole idea here is that the fundamentals still intact, right? And that's really what you actually need to do research and actually go and find out, are their fundamentals still intact if their prices have fallen more than 50%, right? And I believe you will actually find them. All right. So all these numbers, by the way, actually exclude dividends. If I had include dividends, the number is actually way higher, right? And if I included dividends and reinvested those dividends, your returns are even higher, right? And the whole idea here is that I'm going to give you guys some ideas or a feel, right, into really how you're going to decipher or end up holding some of these stocks. I know they're very boring. But these boring stocks give you very decent returns without having to take too much risk, right? Okay, so I think I've got a question here from Aaron here. If you bought an emerging / investment grade stock which fulfills all the criteria of net cash, positive cash flow, with high price, such as high timing risk, do you hold and ride it through? I think in the current market scenario, we are in August 2020. Again, this is my personal view. These kind of events that we're experiencing today, where market volumes have gone up 6 times on average, based on last week. Where your retail investors, there are a lot of new retail investors coming in brand new. They've really just only opened an account, 2 months ago. This kind of, the last time we saw this kind of participation was back in 93, 94, 95, 96, 97, right? That was the last time we saw that kind of participation. Today, it's been 20 over years, right? I would just ride it through, right? Because you don't get many of these opportunities, right? You have to wait 20 years for now. And I believe, we're probably still at the very early stage, and this is my personal view. So the market dynamics have kind of changed dramatically. But the whole idea here is to reduce that risk by making sure that you buy good, fundamentally good stocks. Of course, when they do become overvalued, you can ride it through, but don't forget to take money off the table, right? Because there are a lot of newbies out there who likely won't do that. And coming my own personal experience, you're never wrong by taking money off the table, right? Taking profit on the table, right? So I hope that answers your question, Aaron. Okay. Yes. Well, okay. So, T, you mentioned there's no banks in the list. You're right, because banks actually don't have positive operating cash flow. So for that reason, they have actually been taken. Not by design. It's just that this criteria that I've put out here generally would exclude banks, because most banks won't have that, operating cash flow, right? So these are all non-finance based companies, either manufacturing or in services, right? They actually give you some pretty good returns for the risk that you're taking, right? For the risk you're taking. Okay, so I want to show you the result, right? Let me show you, and to be honest, from some of these stocks on this list, a lot of these prices actually have not gone up. In fact, they've gone reverse. They've come down instead. So the question is, when we look at this list again, 2025, will you be better off without taking excessive risk, right? That's the whole idea. Okay, so what I'm going to do now is this, right? Okay, so I have a good question here from Yin MK. I bought 𝗚𝘁𝘃 at January 2020 and stuck at the upper floor. I eventually switched to another stock post and saved this portfolio. So when will you decide to restructure your portfolio in unpredictable circumstances? So guys like 𝗚𝘁𝘃, you would be kind of stuck because they are in a consumer segment, and of course because of COVID, consumption is expected to slow down in certain segments, right? So that's really the hardest point here is really not to hold on to your stock so tight that say, yeah, this is mine, and I'm right about it. Sometimes markets will have to dictate, right? So the whole idea now is that you need to pick. There's so many opportunities, you have to pick the best one, right? And for me, the point you have to eventually realize when the market is against you, it's going to be pretty hard to actually outperform the market. So you have to, no choice but feel emotionless and move it to the next stock, right? Or next sector, right? So like I said, a lot of the consumer-based stocks are really down today. So perhaps there could be opportunity going forward into the future, right? I don't think a lot of these consumer stocks will actually disappear. They actually carry fairly little risk eventually when the markets and consumptions do come back. So for that risk, getting a 15% return is and here's the best thing about investment grade stocks, right? You get to sleep soundly at night, right? You're not going to worry, business will still be running, and you should completely ignore price, right? That's sort of the whole idea behind it. Okay. Yeah, so they actually help you sleep peacefully at night. Okay. And they're a lot easier to manage. Okay, so I'm gonna just sort of go back now, so that now I've shown you guys some of the returns. Actually, I want to give you guys an idea how you can use some of these techniques that I want to share with you to actually reduce you're going to reduce your risk, that's for sure, but how are you going to find some of these stocks that actually has that growth potential going forward, right? Now, so to give you guys an example, this was an idea just to show you, right? So this is Nestle. You can see Nestle every year. If you can see this mouse that I'm pulling through, every year they've been making profits, right? And every year they actually pay dividends out, and every year they have positive operating cash flow. So that's the kind of idea you have behind investment grade stocks. Now, just because they make profit, pay dividends, and have cash flow does not necessarily mean that they will grow, right? And that's where you actually do need to put it in some hard work to actually understand the business, to get clues as to where the growth is going to come from, right? And this can only be done if you understand the business well enough. All right. So from a portfolio perspective, I just want to give you guys an idea. Now, if you have only 100% investment grade stocks in there, unfortunately, you may your return is not going to be that exceptional, right? If you had, right? Don't forget, when you put stocks in your portfolio, you're going to win some, you're going to lose some. You're not going to make 100% right in terms of decisions, right? And that's the whole idea. So net, if I estimate based on a structure, if you're going to build, if you build 70% of your portfolio investment grade stocks, my estimate is your return is probably going to be about 12%, right? If you do like a 50-50 where investment grade is 50 and the rest is the other 50, you possibly can get about 15% per annum. And of course, if you want to take a slightly higher risk, then you go into emerging, cyclical, turnaround, and startup companies. And really, the idea here is that you own a lot less investment grade stocks, right? And that will give you a higher return. But don't forget, the higher return carries higher risk. Yeah. Okay. Okay. So this was like the screener that I filtered out these companies. If you look at them, you can see some of them are pretty decent, right? Like here, 18 years profitable, 18 years pay dividends, 18 years got cash flow, right? So these companies actually kind of help you sleep better at night. Even things like Ajinomoto, right, which is such a staple. If you look at them, they have also done pretty decently. 19 years they made profit, 19 years they pay dividends, 19 years they have operating cash flow as well, right? So like I said, these are all very boring and pretty lazy stuff as a lazy investor. But for the risk that you're taking, they give some pretty decent returns without you having sleepless nights, right? We've got a few more here. Every year they kind of make money, right? So the idea here, the whole idea here is very simple, right? How do I reduce this risk and ultimately grow, right? So I'm going to talk about the factors for growth, right? So this is a very important topic because if you want to know if your company is going to grow or if your company is growing, you need to understand why, right? And if you don't understand the company or the business well enough, you're not actually going to be able to do this, right? And that's why I always stress that you have to use data with context, which means that there is a certain narrative to the numbers, right? Which means numbers cannot be used purely in isolation. Okay, so there are 4 factors that I want to highlight. Okay, there are 4 factors of growth that you're going to highlight. One way that your company can grow is that it increases the price of its product. Okay, and one very company that we see has been doing this consistently is actually Apple, right? So if you have an Apple phone, you notice that they've been consistently increasing the price of their phones, right? Why? Now the question is, they're able to do that and still sustain the volume. How are they doing that? Because they have this thing called economic mode. They have a good brand. They've got a good following, right? The second one is there is an increase in demand or volume, right? And this is where we are now facing with COVID-19, right? There are shortage of gloves. There are shortage of PPE. There's a shortage of, because this was unexpected, right? COVID-19. So there are new, the whole healthcare is in limited supply, and there's suddenly a big demand, right? For some of this. So those are the factors of growth that we are facing currently, right? The third one of factor of growth is actually if the company starts increasing its capacity, which means that, hey, you know what? I got one line now. I can't cope. I'm going to build second line. I'm going to build third line. I'm going to build fourth line. And if you can see this, you actually can almost predict that growth will come. The whole idea here now is that you want to get it at a lower timing risk, and that's it, right? As long as you have the fundamentals. So my assumption is that if you have the fundamentals, if you see a company investing in capex or capital expenditure, if you can, how do I say, if you see them increasing their capital expenditure, you're more likely that business will grow. Okay. Now, so this is a good point here, right? 𝗵𝘃𝗀𝗀𝗀𝗃𝗀𝗀𝗀, right? Reduce the cost of material and labor can be affected. You're right, but that doesn't mean your business is growing. Okay, you can reduce so you got to understand this revenue. If I put it in very similar context, revenue can go up infinitely, right? But from a point of revenue to your profit at the bottom, in between is your cost. Essentially, it's unlikely that your cost can be shrunk down to zero. So if let's say my top line was 100 million, and my profit was 10 million, which means my in between is 90 million, right? So if I'm able to reduce my costs, yes, I can increase my margin, but that doesn't mean that my business is growing, right? And that's the whole idea. We want to buy into stocks that are growing or businesses that are growing. What you've just mentioned, it's actually efficiency, improve its efficiency, right? But may not necessarily mean there is growth. Okay. Now, so it's a good point. Thanks for sharing. So if you think about this, and the last one is new business segment, which is what we're seeing a lot today. We're seeing, without mentioning names, we see that a lot of companies that are kind of, I think Bursa even issued a recent sort of query, right, to say that you cannot unnecessarily announce anything that's COVID related unless it's real, right? So you're seeing that a lot of companies are now getting a new business segment. They're getting into, let's say, healthcare, which they previously were not. Okay. Now, this is also another factor of growth. Okay, it is possible. It is very, very possible, right? So all these are these are the four factors that that, of course, if I want to go them into much deeper, you can actually go deeper and actually go in why is there increase in volume, why is there increase in demand, right? Increase in selling price is quite easy. Increase in capacity is quite easy. New business segment, it's about also possibly increase in demand and volume, right? Okay, so let me just, okay, I'm gonna answer a few questions that you guys have. These are some good questions. So Yin, right? Alvin, do you consider if an export-oriented company who exports externally, right, internationally, will they have bigger potential? Yes. No, I give you two factors why I like export companies, right, rather than just purely domestic companies in any country, for that matter. Okay. You see, when if you can move and export internationally, this means that you can now compete internationally in terms of price, in terms of volume, in terms of quality as well, right? So it really says something about your business if you can export. That's the first one. So you're actually looking in terms of quality, right? Of course, when I say this is very largely it's a very general statement, right? You can see, right, for example, in Malaysia, we've been trying to export our national car for the longest time. Yes, it's a huge market, right? But unfortunately, we've not been very successful in doing it, right? Why? Because we've not been able to meet some of those standards, right? Or be able to compete globally, and that's why we're only big domestically, and that's what you don't want. So the first thing is that you talk about standards and quality, right, of the company you're investing in. Number two, right? Of course, if you can sell internationally, that's even better, right? Because you have a much larger market. But again, it depends. It depends what kind of business they're in, right? I guess if you could be domestic based and you could sell, say, services internationally, those will also be good factors as well, right? But yes, so I hope that answers your question, right? So let me sort of try and answer some of the questions here. So in evaluating your portfolio, how do you grade them? Underweight, overweight, when targets are met or not, when quarterly reports are out, how would you rebalance them? All right. Look, when it comes to portfolio, it becomes a bit of an art, right? First, you need to understand the businesses that you have, right? Now, if you cannot grade them, means you don't understand them. That is very simple. When I say grade them, I mean, even if you don't use startup, emerging grade, investment grade, it doesn't matter. You can grade them from risk 1 to 5, for example. That's all you want to do, right? And when you actually look at the structure of portfolio, that will give you the answers of what actions you actually need to take. Of course, stocks that are overvalued, yeah, you should take some profit for sure. Potentially plow them back into investment grade stocks with potential as well, right? At a lower cost, right? You can reinvest into investment grades at lower risk. Okay, so I hope that answers your question. Okay. So growth can be good, growth can be bad. Okay, so love to hear your thoughts. Do share. Love to hear your thoughts on this. Now, the reason why I'm talking about growth is that typically the market actually rewards companies that grow over time, right? When I say reward, I'm saying that reward them in a price or price discovery, right? So their price actually reflects the value of the business, right? And that's why value investing is still very alive and well, is because the markets typically don't price companies at correctly all the time, right? So when you are very speculative, prices can go way above its fundamentals, right? Sometimes when it's really sentiment's really bad, prices can be way below what the actual business can be worth, right? And the whole idea here is that why are we looking for good companies with low risk that actually has growth potential? The whole idea is that because as a business owner, you want your business to grow. Eventually the theory is that price at some point will have to catch up to the business as well. So that's the idea behind growth, right? Now, I'm going to give you guys a couple of examples, right? These are some old examples, and I'm purposely using them old because then I can show you the result today, right? Of course, these are some of the teaching materials I had to dig up that I used back in 2015, right? So this was what happened. So this company was called 𝗦𝘁. I think if you guys are not familiar, they're a multi-level marketing company, right? Now, what happened was, if you notice that their revenue grew from 855 million to $1 billion, right? And then it's like, hooray, right? Now, but what is interesting was that here's the thing, right? Revenue went up, but profits came down, right? That's not what you want, right? And you kind of have to dig further as to what happened really. And if you look at this, one of the biggest things that happened during this period was that our ringgit to US dollar actually weakened significantly, right? And when we do that, what happened was, because 𝗦𝘁 actually imports most of its products, what then happened was that they also said that their revenue growth was 19%, 1 billion, right? So I always say that revenue is vanity, right? A big revenue doesn't necessarily mean it's good, right? So in this case, it wasn't an increase in demand, right? But because its product, because the ringgit weakened and imported products, therefore the product prices went up. And really what you want to find out was the volume still the same after the net price increase, right? And that's why if you look at the profits actually came down, right? Because their cost went up. So really, what I'm trying to say, if you have a rise in selling prices, right, that can sustain volume, that's okay, because it gives you an idea how strong of a moat the company is investing in, right? If you're like Apple is doing two things at a time, right? They're constantly increasing prices and their volumes keep going up, right? That is obviously a very, very difficult feat to achieve. And that's why in the whole world, there's only one Apple that we can see, right? It is very difficult to achieve, right? So that's how growth can come from, okay? I'm going to show you another one, which I'm going to bring it back here. I'm going to talk about increasing capacity, right? So if you talk about increasing capacity, so this was a company called KESM. What they do is they do burn-in testing. They do they're a service-based company that does burn-in testings for the semiconductor industry, or very largely the automotive industry, right? And if you look at them, because they've actually been investing in more machines, you can see their capital expenditure actually ramped up quite significantly, right? In 2017 to about $150 million. But what you can actually see is that when they keep increasing capex, what happens is that cash flow kept improving over time. So which means they're doing something right. Which also means that there's growth in the business, right? So for a company to actually invest more, they must see that there is a return. Otherwise, why would they invest in the first place, right? And the whole question is not only should there be growth in revenue, there should also be growth in the bottom line, right? What you don't want to see is growth in revenue and decline in the bottom line, right? So that's just to give you an example what it is, right? Someone earlier asked me about 𝗏𝗲, right? So if you see 𝗏𝗏 was a fairly easy one. So if you look at 𝗏𝗏 and I put them on the top 10 list, they've done really well, right? So one of the things that they actually did was that they invested a big chunk of money in 𝗦𝘁𝚀𝗀𝗁𝗃 to actually build their current manufacturing facility, right? With all the efficiencies, everything's all built in. You can see the impact was quite significant. You're looking at almost $1 billion ringgit, right? Investment capacity, and you can see investments like them, like 𝗏𝗏, it took them 2 years to actually get the whole project up, right? So I know there was a question earlier that mentioned that 𝗏𝗏 is going to double in size in terms of the capacity. The question is, are they doing it in the existing infrastructure, or they have to build something else entirely to cater for the double capacity? right? And that's where you need to do a little bit more research. If they can, even if they can, looking at it, you're looking at about a 18 to 24 month time frame if they were to rebuild a whole replacement capacity, right? What you can see is that the idea here behind is very simple. If they double the capacity, can revenues double, and can profits also double or more? That's the whole idea. How you want to figure out whether it's good value or not. So to answer your question, look at how much they're investing. As we said, double. And you have to. This is where it's toughest, right? Because you have to put in assumptions, right? The question here is, what is the average selling price going to be after they've completed their expansion? What is the average selling price? Is it going to be higher than where we are today, or is it going to be lower, right? Is there still going to be a short demand? Is there still going to be a short supply of gloves in 5 years' time or 3 years' time or whatever time? Or will there be an oversupply? Because obviously, if they increase capacity, every other glove manufacturer is also increasing capacity, right? So is this going to be a constant thing when they finish it, right? For you to give you an idea what kind of profits they'll make, and multiply by PE, right? So that to be very honest, is quite a hard question to answer, because you have to predict quite far down in the future, right? And that gets quite tricky, right? But they actually have had a very good track record in investing and actually filling up the capacity. So they are by definition investment grade, meaning they have 10 years profitable, 10 years cash flow, and they also pay dividends for the last 10 years, right? So just to give you an idea, right? So if you want a stock that sleeps well at night, so the question here is more timing risks, right, rather than capital risks, regarding 𝗃𝗲𝗀𝗃𝗲𝗁𝗃𝗃𝗀𝗃𝗃𝗃𝗃𝗃𝗃𝗃𝗃. So you can see this was back in their 2015 annual report. They built a new glove complex, which they call it the 𝗦𝘁ci. It's advanced production technologies and so on and so forth. Just to give you guys an idea, this is what it looks like. I've actually visited it twice. It's actually out in Sepang, actually. So if you guys can see, it's actually out in Sepang. It's big, right? And I think they keep housing more and more lines here, right? So the question is, if they're going to double production, is it going to be in the existing facility or going to be the new one? All right. The second kind of increasing in capacity that you guys can actually see, especially for finance-based companies, is actually Young Credit. Young Credit was back in 2017. So they are a lender. So they are a finance company, right? So credit card, motorbikes, second-hand car sales, personal loans, right? That's all they do. Consumer-based, very consumer-based, right? And they've done really, really well. So if you look at track record, they have 10 years profit, 10 years dividends, right? But not cash flow, because it's not applicable to them. Now, what they did back in 2017 was they actually raised 432 million in a rights issue. Now, what it then gives you an idea is that they are expecting business to go even bigger, right? And they are expecting business to grow over time. And that's why they are actually recapitalizing their, or how do I say, increasing their capital base so that they can lend more, right? And this is always a good sign, right? Of course, if you can look at them, in 2017, you can see they actually grew their profits, right? In fact, up to 2020, if Corona did not hit, you can see the growth was it's 1.1 to 1.5 billion. Now, this net profit number here that you're looking at, I don't think it's a fair figure, because that was really when kind of the whole thing started hitting, people start losing their jobs, and of course, it's likely that this financial sector will be impacted, right? But you can see from the extra capital outlay, they actually managed to improve their business, right? So that's another way of looking at of growth, right? Looking at growth. During that period, this is what has happened over the time period. So 2017 was 11 all the way to 16. Of course, this is where we are today, right? For obvious reasons, why we are here today. But really, just to give you guys an idea, or case study, right? When you are looking for growth in your investment grade companies, these are the kind of things that you may want to include. Okay. The fourth segment that I have an example here was this company that I invested in back in 2016. I think mid or early 2016. I can't remember, 15 or 16, around that period. What was interesting was this: QL Resources said that they were going to bring the Family Mart franchise to Malaysia, and they had a 20-year exclusive deal to bring Family Mart, right? I know at that point everyone was crazy, like, you already have 7-Eleven and all. Why do you want Family Mart? And it took me a while, but I started observing, people are crazy about their matcha green ice cream, and the I can't remember what it's called, where they put meatballs on the stick and then they boil it and then you put it in a cup, right? I can't remember what it's called. I kind of noticed, and really what they were offering in the retail segment was actually very vastly different from most convenience stores, right? Odin, yes, thank you, 𝗏𝗏𝘃𝗃𝗏, right? And what I did was, at that point in time, their initial projections was to open 500 stores in 5 years, right? I think then they revised their numbers to 300 stores. But even then, you can go to the website and kind of almost every other week, you're going to see a new store being added to their group. Now,